Hello everyone, welcome to my YouTube channel. This is Sadiq. So in this video we will be talking about Sensex and its crash of over around 4,000 points this week, and also investors lose around 16 lakh crore, and you can see these numbers are very huge numbers, right? So and also most of the retail investors have been invested nowadays, and there is an increase in retail investors these days, right, from corona onwards. So now the impact has been like to also normal people also, because they are also invested in this stock market. So we will look after all the details and the reasons behind this fall, and how long this fall may be, and is India strong enough to bounce back in terms of stock market. Yeah, we'll look into details of everything in this video. Before heading, a small reminder from my side that if you are new to this channel, then please like, share and subscribe to my YouTube channel, and also share it with your friends. Okay, let's begin then. So if you see the statistics here, the Sensex plunged by around 4,100 points, and also it wiped out around 16 lakh crore of investor wealth. So this sharp decline, the reasons are like Iran and Israel conflict, okay, and because of that oil, if the conflict increases, then there is this proposals of attacking the nuclear energies, and also to attack the oil resources of Iran. So if this happens, there may be effect on the global economies, and it may affect on the stock markets also. So with that fear, and also there is an increase in logistics cost, and exports may decrease, so everything may happen, right? So because of that fear, and also there is the stimulus measures by China, most of the foreign institutional investors, they are flocking from India to China. They are taking money from India. Around 32,000 crore has been removed from Indian stock market, and they are moving to China to invest there, because see, obviously any investor wants high returns, right? If he feels that the returns are more in Chinese market, then they will go there. Because why the returns are more in Chinese market? Now they are assuming because the government of China is providing some stimulus measures in the sense like to make the economy expand, and also to make more spending. They do this stimulus measures to increase the growth of economy. They do these kind of measures, okay? And also you can see that in Thursday's session itself, Sensex dropped by around 17,069 points, and before settling with a loss of around 809 points. Nifty too fell around nearly 1% in Thursday's session we're talking about. And also over the last 5 trading sessions also, Sensex dropped around 4,000 points also. And also the market capitalization of the BSE stock exchange has shrunk to 461 lakh crore, and the loss of around 15.9 lakh crore. And it is said that this week was the worst for Sensex and Nifty since June 2022. Okay, Sensex ended with around 4.3% drop, right? And also Nifty saw around 4.5% fall. So these are worst since June 2022. So for these institutional investors, the valuations has been a big worry for them, because there is a sharp increase in valuations in Indian stocks. So yeah, for that sake, they are showing not much conviction in Indian price points right now, Indian stocks price points. So while most of the investors are fearing for there will be more correction in coming days, but the India has very strong macros in the sense like there is consistent flow of SIP money, and also the economy credentials of India is so good, the fiscal deficit is good, and the foreign exchange reserves are good. The macroeconomic stability is so good in India, and also the domestic liquidity and consistent flow of SIP money all are all very good factors of this Indian economy. So there is still a lot of cash left in mutual funds, like mutual fund companies. They are left with a lot of cash, or also they are waiting for more correction to enter into market. And also the high net worth individuals, they said at HNIs, they are also waiting, and PMS fund managers are also waiting with full sacks of cash to buy dips in the coming days, okay? And there is also a report that mutual funds have been sitting with a cash pile of around 1.86 lakh crore, and they are ready to invest those. Obviously they should invest, right? So they are also waiting for the correction. However, in this fall there is some positive also, like IT stocks. They remain strong because of their insulation from sell-off due to improved sentiment following the easing of US Federal Reserve's monetary policy. Because of that US Federal Reserve's monetary policy, the IT stocks are a bit insulated, like they don't have that much effect of this fall in stock market right now. So that's a good thing. Also, the active equity mutual funds in India with a fund value of at least $1 billion held an average of 5.39% of their portfolios in cash as of August ending. So this is the highest levels in the last 5 years according to the data of Morningstar. So now the play comes for domestic institutional investors, DIIs. FIIs are keeping the market high till now and they are getting withdrawn, and now the DIIs have to take charge, and the DIIs were keeping a quiet note till now. Now it is going to be a test for domestic liquidity, and the buy on dips camp will be tested now. So you can see on Thursday's trading session, the domestic money like FIIs recorded the highest ever single day exit worth around 15,240 crores, and on the same day the domestic institutions countered it with the highest single day buying of around 12,900 crore approximately. So you can see that there is some withdrawal and also there is some entry also there. So DIIs should be very strong for our stock market to be flying high. So this market in future, in the near term, we can say it will be a fight between both FIIs and DIIs as per the experts. And also experts are saying that not to worry regarding the current slowdown of stock market, and also they were saying to hold on to our investments, hold on, and not to be in hurry to book losses. They may recover. There is also thing like domestic retail investors have just joined the party right now, and Indian households have about 5% of their assets in equities, and a third of the amount is placed in lower earning bank deposits. And there is a continuous SIP funds are also coming from retail investors right now. So consistently they will be coming, right? SIP is also that is also a big strength. And India's middle class, there are tens of millions of savers, and that all will enter a stock market to seek better returns now. And many will use this SIP method which we spoke earlier. And also this SIP will allow ordinary people to invest a fixed portion of their monthly salary, right? So that's a very good thing, and that's a positive thing for stock market. And domestic mutual funds are also sitting on a pile of cash, which we already discussed. And so that's it for this video. And also the thing is that experts are advising investors to follow quality of stocks. Okay, it's not like you can see in social media, in X and all, right? There are so many advisors that sprung up these days, and everyone are giving advice regarding stocks and where to invest and all. So you kindly have to do your own research work and give some time. Okay, give some at least 1 hour of time for the stock which you are investing. Know the financials of that company. And yeah, I'm not financial advisor also. So yeah, but with a little bit of knowledge what I have, I'm saying. So be careful while investing in stock market. I'm also there in stock market for the last 4 to 5 years. So with that experience, I'm saying. And now going forward, the market will be tracking the Q2 earnings, right? I think some of the companies have released Q2 earnings also. So market will be tracking the Q2 earnings also. If that that also comes good, then it will be a beneficial. So that's it for this video. If any updates regarding the stock market and its related news, I'll update you. For more content, please like, share and subscribe to my YouTube channel, Sadik Explains. That's it for this video. Thank you. Bye bye.